Hi, I'm Mark.
And I'm Steve, and welcome to Bytes by Standard Chartered's Chief Investment Office.
In this episode, we would like to share with you the strategies to tame the inflation tiger. The number one concern at the start of 2022 was inflation. The recent tragic events in Ukraine have amplified this, with the dramatic increase in energy prices. In times like these, it is important not to lose sight of the long-term investing principles learned from decades of financial history. One of the primary lessons is that if you are really worried about inflation, the worst thing a long-term investor can do is to sell out of equities or private assets, as these are the primary assets which are likely to protect against inflation in the coming decade.
How do we then position ourselves? Have a plan. For most investors, the number one goal of an investment plan is to prepare for retirement. The challenges here are huge. Generally, the longer the horizon over which you are trying to predict, the less confidence you have in those predictions. An average 30 years old, for example, will probably have to make decisions on earning a living, accommodation, marriage, saving for kids' education, and retirement planning.
Inflation also has to be taken into account, especially with such long-term horizons. In Asia, inflation has eroded the value of local currencies markedly over the course of the last 30 years. Against this backdrop, most financial asset classes, with the exception of cash and deposits, have delivered returns that have retained purchasing power. Global equities and private equity have led the way, delivering an annualized return of 8.5% and 13.6% respectively, in the 10 years to September 2020, handsomely beating inflation.
Bonds have also done well since the early 1980s, as central banks declared war on inflation, and structural disinflationary pressures kept the downtrend on interest rates and bond yields intact. We believe it is getting harder and harder for bonds to generate strong returns going forward and outpace inflation. Lower starting yields mean that bonds will likely lose purchasing power for investors, even assuming inflation normalizes back towards 2%.
For investors looking to beat inflation, we have some good news. First, we expect equities and private assets to continue to provide a good hedge against inflation in the coming years.
Second, in financial markets, the longer your time horizon, the greater the confidence you can have in the expected outcome.
Finally, long-term expected returns have generally proven to be reasonably accurate and therefore can be used as a decent yardstick when it comes to planning ahead.
What our analysis also shows is that future returns are likely to be lower than those in the past decade. This makes it even more important for investors to focus on building foundation allocations centered around global equities and private market assets.
Far too many investors have excessive cash holdings or are too reliant on bond investments. If this remains the case, we believe it would be a major contributor to people losing their purchasing power to inflation and not achieving their financial goals. Thank you for joining us. Till the next episode.